This data tells us that over 98.5% of UK workers are paying more in tax. They've used a stealth tax that quietly has millions more Brits paying billions more in tax and making you poorer every single year. Most people think that taxes only go up when the government raises income tax rates. But here's the catch. In the UK, those rates haven't changed for years. And yet the average person in the UK is paying more and more in tax every single year. So if we cast our minds back, during the election campaign, Labour said more than a few times that they weren't going to touch any of the main taxes on working people. That covers income tax, national insurance, that one's a bit controversial, but we'll come on to it later, and VAT. They said it over and over and over again and even included it in their manifesto. Now, there's a lot we could discuss here, so let's get straight into it. So if you take a look here, the income tax rates have indeed stayed the same, and they have been the same for quite a few years now, with only a couple of minor moves here and there. But if you dig into the numbers a bit more, you'll also notice that the tax bands for income tax have been frozen. So we can see from this ONS data marginal income tax rates. You can see that the basic rate has basically been flat since 2008. The government cut it a little bit to try and get the economy moving again in the wake of the financial crisis. And the high rate you can see here, this has been at 40% going all the way back to the 1990s. But this is a process called fiscal drag, and it is responsible for one of the largest tax increases since the 1970s. And this is a tax that affects anybody who makes more than £12,570 a year. That's the 98.5% of people that we mentioned at the start of the video. So this means that if you earn at least £15,000 a year, it's going to be costing you somewhere in the region of £500 per year in extra tax. But this is called a stealth tax for a reason. It hides in plain sight, but nonetheless is making you poorer every single year. Now, I want to get into an example here to clear up two of the really key items that we'll have to dive into to understand the vast scope and unimaginable scale of the tax grab that is going on right now. So if you have someone who makes £50,270 a year, now I know it seems like a weird number, but for the purposes of this example, just work with me on this one. That means you pay tax at two rates. You have your personal allowance, which means you pay 0% on £12,570. And then you pay a basic 20% rate from £12,570 to £50,270. Now, on this portion of your income, you only pay 20% tax. Now, let's say you then get a pay rise of 5%. Your new salary is £52,784. But because you've now crossed over that threshold of £50,270, all the income above that will get taxed at 40%. And this is really the first thing I want to point out in this discussion. The UK operates a marginal income tax system, so only the pay rise above the income tax threshold will get taxed at 40%, not your whole income. People still make this mistake time and time again. So you'd only pay 40% on the £2,514, which is £1,005, which means you get to keep about £1,500 of your pay rise. Now you might look at that and go, well, that's fine. I've got a 5% pay rise in gross terms and a 3% pay rise in net terms. That doesn't seem too bad. But we start to add in some factors, and this is where it gets ugly in a hurry. When you start to add in the cost of inflation, this is where things get really tricky. So if inflation is also at 5%, which given the recent inflation numbers doesn't feel like a crazy thing to say, but never mind, that's another conversation for another day, then that means you need to have at least a 5% pay rise in order for you to be no worse off, because inflation in all its various measures shows how much more expensive things have gotten over time. What it ultimately means is that your 5% gross pay rise is entirely eaten up by inflation. But it's actually worse than that, because you have to pay more in tax in a world where everything is more expensive, so you're worse off than you were before. Now, we have so much data at this point that backs up that fiscal drag is real and is affecting millions of people's finances. Just take a look at some of these. The number of higher rate UK taxpayers expected to hit more than 7 million this year. Frozen tax thresholds mean an extra 500,000 to be taxed at 40% on some income in 2025 to 2026, HMR figures show. An estimated 1.13 million workers will pay 45% on their earnings, almost 5 times as many, £236,000, when the rate was introduced according to investment platform Hargreaves Lansdown. So how can you fix this problem? The easiest way to do something about this is to increase the income tax thresholds every year by the rate of inflation. Again, if we throw this data up, what do we see? You can see here, as we've mentioned, that the basic rate and the additional rate have been frozen for the last 20, 30 years. But when we look at the tax threshold, these have also been frozen. Now, this means that as people's pay increases, more and more of their income gets pulled into higher and higher tax brackets. This is the fiscal drag that we've been talking about. The personal allowance and higher rate thresholds have stayed pretty much unchanged since 2019 and 2020. In his infinite wisdom, Rishi Sunak decided to freeze the bans. This was supposed to expire in 2026, but was then extended by Jeremy Hunt. Now, in the interest of balance, we should also say that this is something both parties have done, and not just in their most recent iterations, but for decades. It's been a steady and reliable way to increase the tax take without touching the headline rates, which can be politically toxic. And I do want to go into more detail on this later on in the video, because although we're talking about income tax now, this is by no means the only case. This is everywhere. So then this leads us to our next obvious question. If income tax bans had increased in line with inflation, what would the numbers look like now? So we'll put up on screen what the current income tax thresholds are, and then what their inflation-adjusted numbers would be. And again, the data to back this up. Now, I know this is a simple calculation, and there is more to this data. There is more analysis that you can do in order to do this justice. But for the purposes of some quick analysis, just work with me on this one. According to Bank of England data, the cumulative effect of inflation since 2020, when the thresholds were frozen, is about 28%. Because don't forget, inflation is a year-on-year price increase. So then we apply that uplift to the income tax brackets, and we get some pretty shocking numbers. So the personal allowance is currently £12,570, but adjusted for inflation, this would be £16,048. The upper limit of the basic rate is currently £50,270, but the inflation-adjusted number would be £64,179. The upper limit of the higher rate, charged at 40% tax, is £125,140. This would be £159,765. Now, oh my, we are talking about thousands of pounds in additional taxes paid per household and billions in tax increases every single year. Now, as I alluded to earlier, this is not just isolated to income tax. This has been going on absolutely everywhere. Income tax, national insurance, inheritance tax, savings allowance, stamp duty, fuel duty. But all of this is made even worse because it's on top of a bunch of other allowances which the Conservatives have cut. Rishi Sunak decided to cut entrepreneurs' tax relief from £10 million down to £1 million. The dividends allowance was also cut. It went from £5,000 down to £2,000 and then was cut again down to £1,000. The capital gains allowance used to be £12,300. This was reduced to £6,000 and then has been reduced again to £3,000. And we should point out that this is going to have basically the same effect. As people's assets get more valuable, they're going to end up paying more and more in tax. If someone's house is more valuable, it's more likely that they're going to end up paying inheritance tax, for example. At the moment, only about 4% of estates are actually liable to pay inheritance tax. But given the changes that have been made to inheritance tax, this number is expected to hit north of 7%. This is partly driven by people's house prices increasing gradually over time, but also because pension pots are going to be included in the value of someone's estate, this is going to be another big bump as well. But this leads us on to potentially the most important question, which is the UK an outlier here? Now, holy smokes, I'm preparing myself for this one. But we are going to back this up with cold, hard data. And I know this is going to be an unpopular thing to hear, but take a look at this. When you look at other OECD countries, UK taxes are not as high as you might expect. Now, don't get me wrong, I get that this is all relative, that higher taxes now compared to 10 years ago or even 5 years ago will make you worse off. That is totally fair. But also the rate of the deterioration of people's finances after 2020, the inflation shock with energy prices, inflation, and freezing all these tax thresholds all at the same time is absolutely a bit much. But let's look at the data. UK tax revenue was 33.5% of gross domestic product in 2021, the most recent year for where there are internationally comparable data. You can see the UK all the way down here in red. This is slightly below the average for both the G7 at 36.3% and the OECD of 34.1%. While UK taxes are higher than most other English-speaking developed economies such as Australia, Canada, New Zealand, Ireland and the United States, they are considerably lower than in most other Western European countries. Average tax revenue amongst the EU 14 was 39.9% of GDP. So what does this actually tell us? Well, if you look here, you can see Denmark, France, Belgium, Greece, Portugal and so on, all well above the UK, the OECD average just here in blue, and then the UK pretty far down here in red. Now, if we go slightly further down, as the data illustrates, we have the US and Canada and so on. Now, look, I'm not saying people don't have a right to be angry. Clearly, when I look at this data, it makes me really angry. You go out to work, you pay your taxes, and then you look at the state of most public services. You see a stretched NHS, roads that look like they were from the moon, and public transport that is so expensive it's barely worth it. And this is the problem. The UK ultimately has this conundrum. You can have US taxes and US public services, so no universal healthcare, very expensive universities, no holiday pay, no maternity leave or paternity leave, very basic services across the board. Or you can have European taxes with European public services, much more generous state pensions, free healthcare, free university, free childcare, and so on. And the UK seems to be trying to do both, but failing at both. And this is where the sums just don't add up. We also have this analysis from the excellent folks at the IFS. Fortunately, the OECD has done all the hard yards with decades of work analysing the tax wedge. This is the proportion of labour paid in tax for the average worker. This includes income tax and both employee and employer national insurance and social security. And the IFS explains it in more detail here. The result is striking. The UK has one of the lowest tax wedges in the OECD for single workers and dual earner families, but a comparatively higher tax wedge for single earner families, but still lower than average. The reason is simple. In many countries, like France, the family is taxed as a unit, meaning that a single wedge is split between either parents or the entire family, therefore bringing their earnings into lower tax brackets. So what this tells us is something that we've discussed a lot in past videos, that the UK tax system is pretty inefficient, that people who maybe have the same household income can be taxed very differently compared to another household who are single, married, not married, have kids, and so on and so on. And I think this feeling is even more acute because it happened so quickly at a time when people's wages were being squeezed anyway. If taxes had just gone up on their own, then the effects might not have been so acute. But when the cost of essentials was going up and taxes were going up, that just wasn't going to fly. So ultimately, what can we take away from this analysis? The short answer is that looking at the headline rates when it comes to tax is only half the story, that you also have to pay attention to the thresholds. That's really where people can be stung and not even know it, and that is the thing that can make you poorer every single year. How the government can raise taxes on you without touching the rate. And when we start to look at some of the numbers we've looked at in the video about the number of people who are paying higher rates of tax on higher marginal incomes, the numbers are truly staggering. We have 3 videos here on screen: why £120,000 is the worst salary, how to pay less tax on your savings, and the average UK salary. Thanks very much for watching. If you like this video, please like and subscribe.